Put options are financial contracts that give the holder the right, but not the obligation, to sell a specific amount of an underlying asset at a predetermined price, known as the strike price, within a specified time frame. This type of option is typically utilized by investors who anticipate a decline in the price of the underlying asset. For instance, suppose you purchase a put option for company XYZ stock with a strike price of $50, expiring in 1 month, and you pay a premium of $3 per share. If before expiration, the stock price falls to $40, you can exercise the option to sell the shares at the strike price. This means you sell the shares for $50 instead of the current market price of $40, securing a profit. However, if the stock price rises above $50, your option may expire worthless, resulting in a loss equal to the premium paid. This scenario highlights how put options can serve as a hedge against declines in stock prices or as a speculative tool to profit from bearish market conditions. Understanding put options is essential for effective risk management and strategic investing in the financial markets.